Welcome to your real estate journey, expert tips for buyers and sellers. I'm Dolly Torres, a realtor and mortgage broker in the state of Florida and Kentucky. And in this podcast, as you know, we'll guide you, teach you strategies, and provide you with advices to allow you to make informed decisions in your real estate journey. I am joined today by David. He's an account executive over NewFi. Welcome back, David. How are you?
I'm well. How are you doing, Dolly?
I'm doing great. I wanted to talk to you about the bank statement loans.
Okay.
This is very common program that we use fairly often, but I don't think that there's a whole lot of information out there about it. So, can you tell me about what is a bank statement program and who would benefit from it the most?
Okay. Well, the bank statement program, it's a good alternative for self-employed borrowers. Most self-employed borrowers are not going to show their true income on their tax return. So it's great from a taxation perspective, but it's very difficult from a loan qualifying perspective. So we know they make the money, it's just then being able to document it. So the bank statement program does provide us that alternative form of documentation. And it does have some flexibilities. I mean, they could use both, their personal bank statements or their business bank statements. So it does provide various flexibility to meet whatever their personal needs are.
So normally, what we ask the borrowers are to provide the last 12 months of business or personal bank statements. However, there's another option for with 24 months. What's the difference between them two?
There's a slight pricing which you would be able to discuss, not so much me, but the benefit, but it's more so of consistency. So if you have brokers, or should I say borrowers, who have some seasonality, and you'll see that tax preparers, for example, they make a lot of theirs in tax season. Realtors, loan agents, make it more in the buying season, the non-hurricane season, shall we say. But so they have that flexibility. Well, it provides us being able to go over a 24-month to show if it happens to be obtaining a loan in what seems to be a down period of time. Underwriters typically may consider that declining income, and instead of using the last 12 months, just use the last 6 months. If we provide 24 months, they show no, it's a seasonality of that income, and we could use the full income. So it helps benefit a higher qualifying income.
So normally is the 24 months without really going into interest rates, because if you do want to go the interest rates, you need to call a loan officer and they'll be able to guide you through it. But because the interest rates change daily. But between a 24 months and a 12 months, which one normally has the best pricing?
Well, 24, because if it's all risk based, it provides a longer footprint. So it would probably be a slight improvement over the 12. But again, it's nominal. I can tell you that the vast majority of our loans are with 12 months qualifying, and it's mostly just path of least resistance, ease of use, less documentation. The more documentation you provide, the more trapdoors you could always fall into as well.
So what is the debt to income ratio that for a bank statement loan? Like how much of a down payment they need to make? Also, what is the debt ratio for a loan to value? The loan to value as far as the down payment, and the DTI as far as the income for qualifying.
Okay, so the loan to value, you can actually go up to 90% on a bank statement loan. Now at 90%, your maximum debt to income ratio is 45. If you get below 85% loan to value, then that max debt ratio can go up to 50.
Perfect. Okay. Anything to keep in mind whenever we're considering, or if someone is considering to apply for a bank statement loan, that they need to provide to the lender in order for them to get approval?
Yeah, the main thing, a couple of things is one, know your bank statement. Do go through the bank statements first, because one thing that is looked at is either overdrafts or non-sufficient funds, because there is a limit of how many you can have in a certain look-back period. So keep that in mind. Now, if it's an overdraft and they have overdraft protection, which means they've attached that checking account to a savings
or something,
then it doesn't matter how many they have. That's just a course of doing business. The easiest way to tell is if there's a fee attached to it, they don't have the protection. It's just an overdraft. If there's no fee attached, then they have the protection. It's not going to be counted against them. But that would be, you do that if if deposits are transfers from another account, those are typically excluded. They're just looking for the true income, and that doesn't mean certain businesses leverage Venmo or Zelle or things to that nature. Those aren't considered transfers. Those are true business.
Yeah, because I remember we worked in one together that they just got cell payments.
That's all it was.
That's all it was.
And that's becoming more common than not. So and that works well. So it's actually not that difficult of a program. The main thing to keep in mind is get the last 12 months, identify whether if you're the sole owner, you get 100% of the deposit. If you're a partner, you get whatever your percentage. So if you have a partner, you're going to get 50%. And then we have to apply, if it's a business account or a personal being used as business, we have to apply an expense ratio. So we would take the deposits, we'd average those, and then the default expense rate is 50%. And then you would apply that to the average deposits. That's what traditionally would be your qualifying income.
And does that expense ratio, because there are some businesses that they really don't have an overhead as higher as other companies. So does it works like the CPA program that we spoke about a couple of months back, where a CPA can write a letter or something saying their expense ratio is 20%, 30%, 10%?
Right. So that's a valid point. There are a lot of industries in which they are. I think the one we talked about, there's more administrative bookkeeping and things that there isn't much. I mean, consultings don't have much. So yes, the default rate is 50%, but we can go as low as 10% with a CPA or a licensed tax preparer's letter certifying that the true and more accurate expense rate is the 20 or 15 or whatever percent it is. And that's what we base the income on.
And to calculate this income, do you normally just look at the bank statements and get all true deposits into the account? And then you add all of that together. So how's the calculation really works?
Yeah, I mean, just a high level overview of it. Yes, it would be we total up the allowable deposits. So if there are others, because we deal with a lot of employee borrowers who have employment income in addition to their business income. So if we see any direct deposits, we're going to pull that out. We'll pull the transfers out, like you said, and then we'll count up the deposits, and then we'd average those out over a 12-month period, apply the expense rate, and then that would get us what our true qualifying income is.
Perfect. And then we add the 50% debt ratio, or if there's anything different with the CPA letter, then
Correct.
we can get that modified, right?
Correct.
Perfect. Anything else that we should keep up, anyone watching at home, that they need to be aware of when applying for a bank statement loan? When would not be a good thing for them to do it?
Just if there are a lot of transfers, like we said, going back and forth into different accounts, that just makes it problematic, and it's very challenging to truly get the established qualifying income. Like we said, if there's a bunch of NSFs and so forth appearing, then that could be a challenge as well. But I want to automatically, if you get the 12-month bank statement, do your own audit of it just to see the transfer, see the NSFs. If you see that there's excessive of both, realize that you do have some other alternatives, like you mentioned earlier, the CPA P&L program and other programs, that there may be alternative programs that you still may be able to provide your borrowers with a loan, just looking a little bit different. So, but you would know that, you determine that just coming out of the gate with reviewing those first 12 months.
Perfect. And one last question that I have for you, David. So how about if a borrower or someone thinking about applying for this loan, they have multiple accounts. They have their general account to do their expenses. They have their payroll account where they also get income deposits into those accounts. Or they just have a personal account that uses business, and then they have another business account that they also use as business. So some borrowers might have 2 or 3 accounts that they would like their deposit to be counted towards. Now, I don't know how you guys feel about all of those accounts together. So what's your perspective on it?
From an industry perspective, a lot of lenders do not like that. They will want you to choose an account. That is one area that NewFi does excel in. We have no issue with commingled accounts. I just had one.
I have done several with you guys.
I was going to say, you know more than anyone that we could do 3, 4, 5 accounts and make sense out of them. And so we do have that ability to do so. So don't shy away from it. It's best, from selfishly my perspective, to give me all the accounts you have. Let's calculate them all out. If we don't need some, then we can exclude them at that point before we register the loan or enter it into the process. But I think it's always best to do the calculations of the income up front, and that way you and your clients know, what's best when they're marketing and looking for a home.
There you have it. Thank you, David. Thank you for being with us. You guys at home, I hope that you have enjoyed our conversation and that you have gained information and insights regarding bank statement loans. And hopefully, if you're considering one of those, you can either call me if you're in the state of Florida or Kentucky. We also have several other states that I don't cover myself, but I have colleagues that do. And if you're a mortgage broker and you want to get signed up with NewFi, you can definitely contact David. He will be more than happy to help you out with that, and hopefully you can help your clients to get this type of programs. Remember, we're here to assist you during this, to succeed in the world of real estate. If you have any questions or needs, we are here. Please be sure to subscribe to our YouTube channel, Instagram, Facebook, TikTok channels, so you won't miss any of our episodes. And feel free to share this information with your friends and colleagues who might be benefit from it. Once again, thank you. Thank you for watching, and I will see you guys next time. Thank you.